Everyone. All right, everyone. Welcome to another episode of Point of More Returns. I'm your gracious co-host, the Masked Investor. With me today, we have Welfare. Welfare, what's new? What's going on? Talk to us.
Hey man, um, feeling good. It's the end of the year coming to an end, and it's been a lot. And I just want to, tell everyone thanks for listening all of this time over the year, and I look forward to what we're gonna do in the upcoming year. And let's just keep getting after it.
Yes, indeed. Let's just keep getting after it, and getting after it we will, because on today's episode, we're going to talk about a trend that Welfare has mentioned, and that you may start to see if you are an investor in some smaller markets. And that is that you are now seeing institution activity in these ancillary markets that aren't the big markets, like where you were seeing BlackRock buying up, Blackstone buying up properties in Atlanta, in Phoenix, and markets like that. You're now starting to see institutions move into these ancillary markets like Macon and smaller markets like that. And so on today's show, we just want to have a quick conversation about why this is going on, why these markets used to be ignored, why the attention now, and why maybe is the edge gone, right? Because these local markets used to be an edge for locals. I mean, you had the market to yourself if you knew it well. You had relationships. You could make some really good money and largely be free of competition. But now the big money's showing up, and so I guess that begs the question: is this a smart long-term position, or is it just a late cycle land grab for them? So I guess the first thing we want to start off with is I guess Welfare. Just curious your thoughts on what changed all of a sudden that made these smaller markets viable and suddenly investable targets for these institutions.
Oh, that's so good, man. I appreciate the way you just even position the question. It's a couple of things. I would love to hear your thoughts too, but one, I think everyone saw the success of like the top tier premier funds coming in and um, able to make a splash in residential, and they were making money hand over fist, just playing the game of holding the asset until it has some level of appreciation and selling it off. And especially coming off we have to mention it because I think this was a factor in it, but coming off the recession and residential prices were um, depleted, and there was a buying opportunity. And I think a lot of institutions saw that and jumped and pounced on it. And now where the market is gone, it's been volatile, but now at the moment, everyone feels that prices are expensive. Now I think some of the funds are looking to exit and move on to the next wave of whatever the investment might be, or exit the asset class altogether. So what I'm starting to see now, just from looking at deals, is I'm in secondary and tertiary markets. So markets maybe outside of a major metropolitan area, an hour or 2 hours away, that, to your point, have traditionally gone to smaller funds or regional funds or mom and pop investors or individual investors that just have one or two rentals, and now you're competing against real funds. Like I'll put in an offer and I'll say, oh, you have 100 million, 200 million, 300, even on the low side of $30 million in assets, and I'm competing for deals. And what I need the numbers to be in terms of my purchase price for the deal to actually make sense in pencil, they can buy at a lot higher rate because their time horizon is farther out than mine, because they don't need the money as much as I would as an individual investor. So I don't think it's going away. And I've talked to other few investors that aren't in my markets, but they said that they've experienced it as well. And I think sometimes it's a wave where the institutions come in and they'll try to gather up as many properties as they can, and then they'll make as much money as they can, and then the ones that they're holding the bag with are the deals that maybe the property went against what they thought it would be, or they just didn't necessarily do the best due diligence, or something unfortunate may have happened, like some type of repairs needed or malfunctions, and then they're just kind of holding the asset. Because what I'm learning is they don't necessarily want to be in the fix and repair business. They just want to be in the asset and inflation hedge / appreciation game. Like, that's essentially what these funds are doing.
Okay, understood. And I just to add on to that, I've seen some stories where just following along in some of the financial publications, do you think some of it's due to like negative leverage in big markets, like like in a major market like LA, where home prices are just really high, and Phoenix, where prices are getting pretty high relative to an interest rate. So essentially, like if you had to borrow money at like 6%, 7% interest, but the assets are only paying them like 3%, right? That's just a negative leverage. So every house you buy in that market would lose money with a spread like that. So essentially what they are doing is they're having to move to these tertiary markets, right? Like Indianapolis, Memphis, Chattanooga, Columbus, just to be able to get a return, just to make sure the spread's positive. So in those markets, you can still, borrow at 6, 7% and still make 6.5, 7.5, 8% on the property. So that would be worth kind of migrating into those cities, I guess. Now, I guess the other question to ask for you too is like, do you think there's like a minimum population or job base or liquidity threshold or anything like that uh, these investors are looking for, or what kind of make it market kind of fill off limits to big capital? What draws them in? What makes it fill off limits?
At one point, I would strongly say, oh yeah, they definitely have a buy box identified with higher limits, higher thresholds than a normal person would. But at this point, I mean, I think they're just looking for alpha. They're looking for some type of return. And so when these big funds take in all of this money, they have to invest it somewhere. And so they're losing money if they just hold it, and they don't want to necessarily give it back to investors, return capital. They don't want to do that. So I feel like they're scrambling, and they're starting to invest in areas where they wouldn't traditionally. So yeah, I mean, to your point, like the top 10 DMAs, everybody wants to be there. Everybody wants to invest there. It's hyper competitive. So that's part of what my strategy is, if I'm being blatantly honest. I mean, I went to a market where I felt there weren't as many people competing, and now I'm starting to see it's an uptick. So I still think maybe if I had to think about whatever their investment checklist is, yeah, it probably has population thresholds, demand, income thresholds, how many top employers, how many do they employ, you know, um, demographic information, all of those are taken into account. But I'm just seeing an overwhelming amount of institutions
Mhm.
in markets I have not traditionally seen them in. And that's what's a little unsettling, because where do we go from there? Like, where do we go?
Yeah, ultimately. And so I guess you feel that is this patient capital, does it kind of stick around in the same dynamics that happen in these other markets where you got a negative spread? Do you think that eventually takes hold in these markets, or will we be able to drop rates fast enough for these other markets start becoming attractive, and they would kind of pull back and go back to the market? What are your thoughts there?
Yeah, I do. I agree with what you're insinuating. I do think they're gonna wave hop and go to wherever the hot markets or the better opportunities are, because they're agnostic about markets themselves. They just want to go where they can get the highest return. Um, so that's one of the ways that I feel like you can compete, because if I know more about the market, about certain zip codes, about certain areas, then that's just a level of uh, information that I'm going to have that a large investor is just, you can't get that looking on a spreadsheet or some type of AI. Like, you just can't do that. You have to walk the streets. You have to be of it. You have to be knowledgeable. You have to be in it, essentially. And so that's part of with the sophisticated strategy. That's some of the challenges in terms of real estate is still local. It's a localized product.
Real estate is still local indeed. Well, what do you think happens too, though? I mean, it's going back to, what happens when these rates drop. I mean, I know historically, with the commercial real estate market, a couple of years back, I think it was 22, where BlackRock was having some issues with, due to COVID, right? People weren't reading out the commercial real estate buildings. A lot of these office buildings were starting to have higher vacancy rates. And so some of those REIT funds and some of the private equity investors were having difficulties with redemptions, where people were coming and pulling their money out because they were scared of defaults and whatnot. And so what they did is they started getting the funds, right? They at a certain once to withdrawal got to a certain request, let's say 2% of the fund's value for that month. You had to wait in line before you could pull another redemption, and that's a way to kind of keep a fire sale from happening. But in the meantime, they're going to have to, dump these properties on the back end in order to meet the redemption request. So, if that happens in these smaller markets, is there enough activity, you think, to absorb something like that? Or could they get caught in a fire sale spiral where they're dumping properties, but nobody's taking them, so they have to dump it at a lower price, and they're just selling against themselves, and it just becomes a negative spiral to the bottom for them. Any thoughts around that? I mean, what do you see kind of with that based on your experience in those markets?
Yeah, a couple of things. I'll say it won't be as drastic because you're talking about commercial real estate versus residential. So with residential, it's anybody can be a buyer potentially. Someone could be looking to live in the home or flip the home or rent the home in it. So there's a lot more opportunity for interest. But yeah, I am seeing some of these funds they bought in 2017, 2018, 2020, 2012, 2013, and they thought they got in at a really good price, and maybe they had a target of what they wanted to sell, and now they're not reaching it because prices are down right now. And now they're having to sell at not much more than what they bought because they didn't maybe the markets where they're buying in, they peaked and then they didn't exit because they thought it would continue to go higher. And now they're holding the bag. So, and I don't believe the firms that have the properties are interested in being value add investors, meaning you buy distressed property, go in and fix it up. I think it was just purely asset appreciation that they're looking for. Hold it, let time pass, prices inflate, and then just sell. And so now the real challenge is in with these firms is, were you just playing a numbers game, or are you going to be an operator, go in, try to repair the homes, be a property manager, get a resident in there and pay rent and hold it until you can potentially exit? And so some of these firms, I don't think they're necessarily interested in that. I don't think they have the stomach for that.
Okay, understood. They may not have the stomach for that. Well, and speaking of stomach for risk, I mean, what are some risks in these markets that they could be missing, you think? Like, are they, you think they do a good job in capturing risk? Or, I know you mentioned all real estate is local. Are there any strategies you see that these institutions are doing to try to account for them, like men on the ground? Or are they just talking to real estate agents? What are you hearing anything around that? Or
I haven't heard anything specifically, so this is all conjecture. I don't have any intel, and it's anecdotal because it's just the thing that I've seen in a couple markets that I'm looking into. But I think the firms had targets of what they're willing to buy. So it's like, let's just take share. Let's take market. Let's buy as many properties as we can and then figure out what we're holding later. I think that's what they did. And then some of them they bought, for lack of a better term, they're stinkers. They didn't buy good properties. And now they're left holding the bag on some of these, and they don't have the appetite to actually fix them up and get them in the condition to where someone would want to take it off their hands. So they just keep holding. It's like the greater fool theory. They're just hoping they find someone that's going to be a greater fool and take the property off their hands, and they can walk away with some level of profit.
Hmm. Okay. Okay. Understood. Another risk I know I remember recall is I know like some investment firms they're doing what's called like a floating rate bridge loan, right? Where essentially they're building like these huge communities, buying like big blocks of homes, like you mentioned, down in Macon, right? And instead of using like a 30-year fixed mortgage like a normal investor would, they're using that short-term floating rate bridge loan. And the key term there is bridge loan, meaning that the plan is you're using this loan short term to you can get to some more permanent capital. But in the meantime, bridge loans typically are there's some risk in them, right? Either from the investment side with small business acquisitions or private equity. We use a bridge loan to finance the loan until we can get permanent capital raised from the bank. So we need to close the deal today. We'll get a bridge loan, and then the bridge loan will float it until the deal closes 6 months from now when we got capital markets financing that's more permanent, but normally comes with a higher rate. With this one, it's a floating rate loan, so the rate floats up. Let's say they borrow at 4, and rate floats up to 8, but the property's only paying 6. As you probably know, you're in danger then, right? So I know that could possibly be a risk as well, as you're considering all those things that they're taking in consideration. I don't know of any other thing else. Any other things that you could think of, or
Well, let me just put out a disclaimer about that itself. I don't deal with an armed adjustable rate mortgage. And then the bridge loans, he just explained bridge loans are loans you acquire for short-term financing until you get the permanent financing in place. I'm not playing that game. I'm not playing at that level of sophistication. Some things I just like knowing I have in the bag. I deal with fixed interest rate loans, so I know what I'm dealing with. And then if I get into a situation, I'll just try to refi. That's the way that I'm building out my business. But I do understand, and I have talked to investors that will only do interest only loans, or they'll play the arm game. And I'm I can't predict rates. I don't know where rates are going. Some people maybe they feel like they can do that, and more power to them. But we're not advising people to go out and do that on this particular pod. But yeah, we do understand that is how some people are deciding to build their businesses. But I leave that to the institutions, the ones that have the capital, have the ability to navigate those murky waters if things get tough.
yes, indeed. Yes, indeed. And navigating murky waters, I mean, once the water does get murky, how do you avoid getting pushed out by these institutions? Like, do you feel that they're just going to simply come in and take over the market and not leave scraps for local investors? Is there a way that local investors can still thrive in those markets? What's your thoughts on that?
Yeah, thanks for that. So a couple of things. I will say I think about that myself because I'm in the process of changing strategies in terms of my investments. What I've seen is these investors are trying to buy at deep discounts. So some of them are buying distressed, which if you are in the value add space, that definitely takes a toll in your ability to compete for offers. But I had not traditionally had to deal with this because I was primarily buying turnkey properties. And the reason why they weren't looking to buy turnkey is because there's not as much margin. And so the reason why it was appealing to me to do turnkeys, one, I don't necessarily have the skill set to do all of the repairs and the work. It's hours away from where I'm located or states away. And I need boots on the ground to be able to go look at the property. And I have other streams of income, so it takes my time away. But so that's one way. I don't think these firms are looking to do turnkeys. And I'll say people that are doing real estate full time, they are not looking to do a bunch of turnkeys in their portfolios. It might be some, but they're probably doing a lot more value add, or they're looking to wholesale, or they're looking to fix and flip. So to answer your question, if you're in that space of doing buying distress and then trying to fix it up and get a renter in there and then refinance it, I will say get connected with some wholesalers that are doing deals. That's one way, is establish some type of relationship. How do you do that? I was advised, and this is some of the advice that I received, is, a wholesaler getting their good graces, always put an offer out, even if they don't necessarily like it. Try to always support buying their deals. Um, and then once you have some type of rapport, some level of trust, then you're the go-to person. Every time they get a deal, you'll be the first person they call. So that's one way. But the other way is, I mean, yeah, it is competitive, and I do worry that, hey, it'll be nothing but institutions that buy real estate. But maybe that's just me um, being anxious about the whole situation. I mean, it's a lot of real estate out there, so I think there are opportunities to look for. If the institutions are only looking at 2 1s or 3 2s in terms of bedroom bathroom mix, maybe you go to a 4 2 or a 2 1 or a 1 1 or whatever it is, because maybe their buying criteria is a little bit different. So there might be opportunities if you sort of change what your buying criteria is. Or maybe you can figure out a way to get the repairs done at a cheaper rate if you use a certain contractor or you use different materials. Like we have to be nimble, and we have to be vigilant, and think of ways to do something different, because if not, you just won't be able to compete.
Yes, indeed. Yes, indeed. Another thing, I mean, I like what you're saying there. I guess it's simply you can buy stuff that they can't underwrite, right?
Mhm.
So they have a certain buy box that they have to fit. They've run it on spreadsheets and algorithms. They can find a property, but it has to go back to the firm through the committee and, strike and check the boxes that they have. You have a little bit more flexibility than they do. And so you'll be able to take on properties where they see risk, such as something with an ADU, where ADU is unpermitted.
Mhm.
You can go down to the city council and get a permit, where for them to do it's just not worth them sending the foot soldiers in there to do it, unless you're doing it for a whole bunch of properties at one time to get a return on it. So you can be nimble. The other thing is, I guess, like we mentioned before, like what I'm seeing, it sounds like they're buying these houses in blocks, right? So
Mhm.
I guess they're buying them together in boxes together, like a whole neighborhood or a whole street or streets connected to each other. Whereas you can probably go out and buy individually, one house on one side of town, another house on the other side of town. You can kind of scatter out and dip in and dip out, whereas these institutions have to bank them together. So those are kind of some ways that you could still kind of play around the margins, just eat around the whale. But the last thing I guess we want to talk about too is uh, what's one indicator kind of people are kind of maybe overlooking, or what matters more than like headline population growth. So like, can a smaller investor get a market signal that lets you know that, hey, the institutions might start seeing this market that as being attractive and position ahead of it, or anything that you think that signals institutions may be on their way?
Margin. uh, if you're making a lot of money on your deals, no doubt that they're gonna take notice. I've been in my particular market for maybe, this will be 5 years, going 6 years into the summer. And I know eventually they would like realize that it was a good market. And so at this point, everybody has a podcast, everybody has a YouTube channel. Um, the proliferation of tech and AI is making it easier and easier to analyze deals and um, break down and synthesize a lot of data and information quickly. So the moats that existed before with um, like large quantities of data and market knowledge are like starting to come down a little bit. And so yeah, I can look up, I can pick a random market right now. I can figure out what the average rents are. I can figure out what the economic demographics are. And then I can say, hey, for this zip code, give me 10 distressed properties that you think I can make a 10% cash on cash return, and it'll spit something out. Now you still have to run down the information, but my point is there's so many tools out there. And it's just a matter of, I don't know, I think it was Peter Lynch, the investor, said whoever, or maybe it was Warren Buffett, I don't remember, but whoever turns over the most stones wins. And so doing the most research, doing the knowledge, right? That's who's gonna ultimately win. And so that's how I'm trying to continue to compete, is if I look at enough deals and I put in enough offers, I'm gonna win something, and I'm just gonna keep building on that. And that's what I want to leave everyone with, is it's gonna be competitive going against these firms, but there's still ways to win, and you just have to keep turning over stones.
Yes, you do. And one other thing too, I might throw in is, would you probably would chime in on this too. One thing people don't really, I feel like, appreciate enough is true rent, right? The effective rent rate, right? So you've got headline rents, right? Where it's, you see a headline rent on CNN, it's like the average rent in the area is like $2,000. Landlords really hate to drop prices on rent. So what they do is sneakily they'll just add concessions in. So yeah, the rent's $2,000, but you get 2 months free, right? So effectively the rent's $1,750. So that's how they drop the rent effectively without dropping the headline rent. And so as a result, when you start seeing a lot of that kind of pile up, a lot more of those offers where you start seeing signs like 2 months free or 3 months free pop up around, then market is demand has softened and rents are dropping. And that's how you hide it from headline, from the average Main Street American investor. They don't really see it, but as an investor you would, right? And so that's something that just kind of pay attention to see kind of where the market is. If you start seeing that market's going to turn, and just make sure you adjust accordingly. But all right, anything else to kind of end the show on? Or
that's a really great point. I've personally never seen 3 months. Sounds insane. I've seen 1 month. That's the most obvious one I've seen. It doesn't happen, but yeah, I've seen 2 months as well. But 3 months is like, wow, that's a strained market right there, man. That is a strained market.
Indeed.
But that's a very good point, though. It's like, hey, I've also seen people don't talk about this much. I'll leave with this. 2 things. One, people don't talk about the fact that rents slide. Rents can go the other way as well. We always talk about rental rates increasing, but rents also decrease. And so that, to your point, is a really good indicator of, hey, we're not able to get people in the door and we need to try to incentivize them. So that's one. And then just to make sure I said about the quote, it was Peter Lynch who said that about the whoever turns over the most stones or turns over the most rocks wins. So I have to credit Peter Lynch for that. Wrote one up on Wall Street. So yeah, I just, happy hunting. I keep the faith, keep doing the work, and you're gonna get, if you play this game long enough and you put in enough offers, you're gonna get beat by institution at some point on the deal. But just look at it as a badge of honor and just keep going.
Yes, indeed. Well, gentlemen, that's all we have for today. Ladies and gentlemen, thank you for joining another episode of Point of More Returns. We look forward to seeing you in the next episode. Have a good one.